Well, good evening, everyone, and welcome to the PayFred Student Loan and Repayment webinar. There's quite a bit of changes going on with the big, beautiful bill. We'll discuss this a little bit, and it's a big change for high school seniors and below. This will be the first year. This class will be the first class that will face these changes that parents need to be aware of. And again, we're going to go, it's a lot to cover here tonight. So again, most people are financing a portion of this because it's gotten so expensive, and we just have to make better and hopefully more informed decisions. So let's get going. So here's what we're going to be doing quickly, just reviewing what we did last month, I guess, at the Paying for College and what the PayFred approach is. We'll also look at the financial aid overview. That's kind of a review of last week. Last month, sorry. We will just cover that, and just so you see how that ties through, because that's important of how your financial aid positioning works and what type of loans you may qualify for. If you have need or don't have need, again, it will vary by school. And then understand why it's so important, and even now more so with the big, beautiful bill changes, you need to have a plan at a minimum for each child, and it's getting to a point where now we need to have a plan for the family, only because depending on what schools you select, your prior loan decisions will impact your other siblings. So, or if you've already have educated a few children, your debt to income ratios may be a little bit worse, so the private loans could be more expensive than you hope. And I'll explain what those changes are. And we're going to talk about the repayment options to that extent, and that has changed. It's going to get a lot easier, but you'll be limited to what you can do. So, and again, if there's a question, please type them in the chat and we'll answer them as we go along. So just a quick review of who PayFred is. We take a holistic approach, nationally recognized. What makes us really different in my eyes is that we cover the entire process. We do both college funding. We have an in-college solution, so people change majors, transfer. We're able to remap that out. Graduate school, what that's going to cost, and how do you structure that? How do you use your resource the best way? And then once we've structured the debt the best way, if you haven't done that work, what does loan repayment look like? Do I qualify for loan forgiveness? Do I need to file my taxes married, joint, married, and separate? More and more families will need to do that because of the income-driven repayment changes and the increased use of income-driven repayment methods. Let me just say an acronym there. The income-driven repayment methods, you'll hear an acronym called IDR. That is what that stands for. So if by slip of the tongue, I apologize. Sometimes I just go rambling here. With this is the way we look at it. I have always looked at this holistic. I have 3 daughters. We educated them all. And you have to, in the new world, because it's gotten so expensive, it's starting to impact retirement planning. We've kind of been lulled into sleep a little bit with COVID. We basically went 5 years without people making payments, or you could have been able to do that. And that's what's changed. So again, you need to take a holistic approach. And the schools don't provide a good resource there. There's no transparency to the whole thing. And again, that's what our systems do, in the sense that we're actually going to improve that because of these changes. But to be able to see what you're borrowing and what your payment's going to be at graduation will become more and more important. So this is the second in our annual series. We just did the prior month was the Paying and Fast report. This one's the student loans. We're going to dig in a little bit deeper and look through that. Then we're going to do student loan forgiveness. Again, that hasn't changed that much because of the big, beautiful bill, but you're going to have to understand that your debt structure and what qualifies. And then this year is a little bit different. We're going to do a graduate program because now the big, beautiful bill has made a big change. And this will have an impact for your undergraduate. So if they're considering medical school or pharmacy or an MBA or law school, that will need to be considered in their decision making and how you use your resources. Then after the first year, we'll do the saving for college. And then once again, this is directed for the high school seniors, you receive your financial awards. What does that do? How do you compare it? And in this year, again, the big, beautiful bill have a big impact on that information. Just a quick note, the most important website for the federal government, this is do your FAFSA and all your loan data, your grant data is there. For loan forgiveness, all the information is there. Studentaid.gov is the website you need to be aware of. What you also need to have to get access to that is your FSA ID and password. If you have not established that and you're a high school senior parent, you will need to do that. Your child, the student will need to have one. And if you file your taxes married in joint, then only one of the parents will need to have one. If you file your taxes married in separate, then both of them will have to have that, have a FSA ID and password. So this is something you need to have. And again, we recommend every family complete the FAFSA form. We covered that last month. But the reasons there are it helps you with your debt structure properly. And it also tells the schools you have the ability to pay, which is going to be more and more important going forward. So just quick little thing here on what's going on with the college trends on the repayment side and things like that. I think the first question, because it's gotten so expensive, you need to ask your child, and they have to understand the consequences of this investment is, are they going to, get trained for a special career? Is it a certain job that they need an education for? Again, as I said, I have 3 daughters. The first 2 changed schools, changed majors, but they found what they wanted to do. I think that has to be done by the end of sophomore year at a worst case, and I prefer to be sophomore or freshman year, that they at least find the field that they're looking at. It could be as simple as, I think I'm going business. It may not be as finite as accounting or finance, but by the end of freshman year, they kind of have to make that. That avoids the 5th year problem. There's a lot of peer pressure. This is a horrendous time, especially for the high school senior parents, with the FAFSA required, the applications required, your teacher referrals, your letters of recommendation, your transcripts. It can be a very stressful time. And I think it climaxes basically around the holidays, so Thanksgiving into the new year, because they see a lot more family members that get the same questions. Where are you going to go? What are you going to major? What are you going to do? And it just is overwhelming. A lot of it comes from parents, from other friends and things like that. And so if they're not sure, it's okay, but you have to have a plan. It's because it's gotten so expensive, it's not a discovery time as it used to be. For most of the people here listening, this is an important fact that people over the age of 50 are the fastest growing student debt borrowers. So that is an important thing to know. Currently, right now, people over 50 own 26% of the student debt. So everyone thinks it's a younger person, age 24. All the debt is really for Grad PLUS and Parent PLUS loans. So that's the change that the Big Beautiful Bill changes on some of that direction, and then they had to for financial reasons. This is just another view of that same information, and that's the growth rate since 2017 of where Parent PLUS loans have grown. So as I said, people over 50 are the fastest growing student debt borrowers. I just want to address the Big Beautiful Bill here real quick on the changes, and I want to keep this at a minimum to a certain extent. You have to be really aware of it. It will change a lot of the decisions. There has not been much discussed from the high school guidance counselors, from the colleges themselves, which has been pretty surprising. I had a meeting this week discussing this with some of the college people, and it was surprising to me as it's not like they don't want to tell you. They have other priorities that they're focusing on. It's their busy time to recruit and do those things. But they've kind of, I'm going to say, missed it a little bit here on what the impact of this is going to be for parents and families on the funding side, being able to pay the bill the right way. We've gone from what's called the cost of attendance limit. That was prior to this year. You could borrow up to the cost of attendance at a school less the financial aid. So basically it was unlimited for schools, and that's why the schools' prices have gone up. Under the new rules, the government has basically said you're going to be capped at $65,000 as a parent. The student numbers have not changed as of yet, but they will be able to borrow up to $65,000 per child, but there's a $20,000 annual limit. So that's the biggest change for undergraduate, where before, if we wanted to go to that $90,000 school and we got financial aid and it came down to a net number of $60,000 per year you had to borrow, you could borrow that under the old rules. Under this class that will be going in, freshman year, the family between the student and the parent could only borrow $20,500. We'll see how that's going to work in a second. As I just mentioned about the Grad PLUS loans, they will be eliminated. So the Parent PLUS loans have caps. The Grad PLUS loans will be eliminated. So if you have a student that's maybe taking a gap year, or someone is considering graduate school, I would recommend that they consider enrolling for the spring semester. There's a 3-year runway, but there'll be 2.5 years left of that. If they enroll for September, that they'll be able to have that cost of attendance limit available to them. So that's a really big deal. So graduate school also has limits too. As I said, they're addressing the Grad PLUS loans. For an MBA or master's program, that will be $20,500 for freshman year, for first year, for each year, with a $100,000 cap over the lifetime. And for professional schools, which is your medical schools, your law schools, your veterinarians, your dentists, they will have a $50,000 annual cap for federal loans and a $200,000 limit per lifetime. So, again, these are the things, and what's going to end up happening is more and more dependency on private student loans, which now involves the parents for, much more, and it will now require for graduate school. So these are the things you just need to be aware of in the change. Why did the change happen? The government had to really put caps on this because it was just, they're losing money. They're losing about 20 cents per dollar lent right now, and that's having an impact on other items. So Social Security, Medicare, Medicaid, all those things are being impacted because of the student loan problem. Is it becoming worse and worse over time? Now, what they have done is they've simplified this process. I think it's a good thing. I think just having stability is a good thing. I know parents will probably be upset about this, but we're seeing some really issues on repayment where people have borrowed more than they should have, because it's the largest purchase you will make in most cases for most families without a third party reviewing that. So make the comparison. If you have just okay credit and you have any defaults at this point in time, you can get that cost of attendance limit. And parents are borrowing $200,000, $300,000, $400,000 to educate their children. That was allowed to be done. In the new world, you won't be able to do that. So that's, I guess, a thing. Where if you compare that to a mortgage or a car payment, there's a third party that says, yes, we'll approve that. And that's what's changed in this process. So these are things I just want you to be aware of. There's not a lot of press about it. We're out there screaming from the mountaintops because I think it will change the decision you need to make. The biggest fear here is that you make a commitment to a school and then you find out that the financing is going to be extremely expensive on the private side, or you don't even get it. And now you've committed to the school and now you can't go. So that's the biggest risk that we see. So how do you plan for the debt? Sorry to be a Debbie Downer there a little bit, but as I said at the very beginning here, every family should complete the FAFSA form. That will help you structure the debt the best way. The federal government loans have the best repayment methods, have the best loan forgiveness options, and now it's integrated with the IRS data, and so will loan repayment. As I said, it'll improve your debt structure, and it helps you understand what on the school side. We'll talk about this just briefly. We talked about this at length last month. Is enrollment management. And this is, kind of what people don't see or not told in this process. And how does that work? Let me just ask here. Would you clarify, are there limits on private lending? There's no limits to private lending, but this has a formal underwriting process. So the federal government really doesn't have a formal underwriting process. You just have to have decent credits, usually about 630 to 640. But no outstanding missed payment. So if you had missed a credit card payment or something like that within the last, I think it's 180 days, you'll be denied. And so then that becomes another problem. The student will get an extra $4,000, but $4,000 at the schools today, that's not going to cover that. And then you may get approved for a private student loan, but that interest rate may be 13, 14, 15%. That it'll be very difficult. And then what happens is you have the accumulation and that becomes a further problem. There is no limits, but it just gets expensive. So this again is just covering what we did last year. How does the process work? So there's the cost of attendance. So that's the fully loaded cost, which includes tuition fees, room, board, books, travel money, personal living expenses at the schools. That's the typical number that's given. And that's what the schools use. They have an average number. Now, when you go into that, and we can go into much more detail when you get your award letters, is the detail of that. So, are you in the dorms versus suites? Are you in the meal plan, the 15 versus 18? The schools, when they make the original award letter, use the averages. And now what happens is when you complete the FAFSA, you get a student aid index number, that's SAI. It used to be called the EFC. And then that qualifies you for how much need. So let's take the example. I'm looking at a $50,000 school. I complete the FAFSA form. I got a 30,000 student aid index number. I would qualify for a $20,000 of need-based aid. That doesn't mean the school's going to meet 100% of that. Again, that's the federal methodology. You'll be able to see that number. The schools use a secondary process called the institutional methodology. The most common is the CSS profile, and that number is usually unique to most schools. Just want to show you, again, here's what happens when you complete the FAFSA form. The top is called the FAFSA or federal methodology. That number is about $40,000 in the case we just showed here. But when you recognize and you start comparing it to this institutional methodology, again, the most common is the CSS profile, that number is typically higher. And they're the schools that are going to say, oh, we meet 100% of need and things like that. And what you're seeing, you will see your 40,000 on the student aid index number, but then the profile number will typically include other assets, such as your home equity. If you're divorced or separated, it would include possibly the other spouse's income, where the FAFSA does not. And then, when they're saying you made 100% of need, they're not using the 40,000, they're using the 62,000. So just got to be careful what you listen to and how it's promoted to you, and again, making the right decisions. Just want to explain how this process works for admissions. They simplify the process. So you go to those admission days and the school says, oh, we gave out $50 million of financial aid last year. And everyone says, oh, if I get in, I'm going to get the money I need to go. Well, just like there's a academic reach, you hear that term, oh, that's going to be a reach school for me. That's the horizontal line here in this example. We're not going to show you how our system does it. You want to be in quadrant one. And what that's basically saying is I'm above the academic average for the school, and I require less need than the average package. So the average package is the vertical line there. So in the case that you see here, the blue dot is the student on the chart, is they have a financial reach. Now, we're not going to tell you not to apply to those schools, because your child may have the needs they're looking for, and they may be more generous, but it just puts a level of expectation here where, when you hear those promotions that we gave out $50 million and you're hoping, this just says, hey, we may get in, but we may not get the money we need. And to what extent is that? So if you're all the way over on the right-hand side there, you have to be a really special student for them to want that, because you're so far away from the average package. And let me just go back to the enrollment management piece. Schools have up to 300 boxes when they do that, as far as they categorize them. And, they have 60, 70 different items they're looking for. So what state you live in, are you first gen, what major you're looking at, how far are you from the school, what state do you live in? All those things are factored into their decisions, because they're trying to, create the blended class that they want. And, this year they're looking for, business majors versus science majors, males versus females, first gen versus non-first gen. These are the things that are not explained to you of how complicated that process is. That is, again, often misleading for many parents, especially when they get the scholarships. Johnny gets more money than Susie, and Susie's smarter than Johnny, and they can't understand it. Well, there was reasons why that all happens. Now, why do we do a 4-year approach? Again, you have to see how that's going to work, because if you don't have a 4-year plan, you don't know what's going to cost you at the end. So they transfer, they change majors, things like that will cost more money, and who's taking on more debt. Now, especially with the new rules here, we'll see an example of this, of how it needs to work, of why the 4 years is important, because you're going to need a blend in many cases of federal loans and private loans at today's cost. Now, there's a way to avoid that, And we call it the $92,000 rule. We'll see how that works in a second, but that is important. Another thing you need to do is review your timeline, is see how old you'll be when your youngest graduate from college. Again, this is part of our process because that's going to be important. More and more people, we're seeing this now that repayment has restarted. People in their late 50s, early 60s is when their youngest is graduating from college. And now they're going to be right near the back end of their career path, ready to start retirement. And now they have a 10, 15, 20-year loan that has to be carried into retirement unless they can pay it off. So these are the type of things that are important. And then our approach, and you'll see that in a second, is what are we going to have to pay and how are we going to pay it is the new game that we have to understand to maximize the opportunity. So this just gives you a sense of how our system works, the way we approach this. You build a college list, you're looking at different things, affordability, the academic, strengths of the school, how far is it from home? And then we ask you, how much money do you have saved for, this is the approach you should be taking. How much money do you have saved? We don't care if it's in a 529 plan, if it's in an UGM account, it doesn't really matter, but how much money do we have saved? And then how much can the family afford per year? Maybe they're currently paying $12,000 for some type of tuition at a private school, or maybe they have, $12,000, that they can look at it out of cash flow. And that's going to now dictate how much debt and how the debt will need to be structured by understanding these numbers when we see that cost of attendance, get the financial award letter, and how's the cash flows look. That's really important as we go through this. So this gives you a sense of the what and how. And so at this school, the list price of the school is $309,000. They qualified for financial aid. So basically they got $100,000 off. The net cost to go into the school that they've gotten is $207,000. Now we move that down to, that's what we'll be paying. And the next chart, this is again, over the 4 years, we break it up into individual years. And then the 204, the 207 is down there. There's the 30,000. There's the 4 times the 12. Then there's the 27,000 is what the student can get in their name. And now the parents are going to be either directly or indirectly tied to that $102,000 to make up that 129 in total of a shortfall. So this is how the game gets played, and this is how you'll have to structure your debt to pay for this type of school if this is the optimal school that your child needs to go to. This is just a picture of that enrollment management piece. I'm just going to skip over that. We've already covered that, but that's what the system view looks like. And then this is looking at the cash flow. So you can see, again, we use the traditional model of how you're going to do this, using your savings, the 30,000, there's the first 30,000, there's the 12,000 per year. We have a little bit of a shortfall freshman year, and then the student can get 5,500 freshman year, 6,500 sophomore year, 7,500 junior and senior year, assuming they are on student academic progress. And that means that, if say they drop the class in freshman year, and in the freshman year, they have to have 30 credits, we can't consider it a sophomore. And maybe they only have 27 because they dropped the course. Well, they're not a full-fledged sophomore, so they're not going to get the 6,500. They may only get 6,000. So this is important as you factor in, dropping or taking a course. Maybe you take a summer course to make that up, but that's how the game gets played. It's called SAP. Then we see the shortfalls are the red here that we need to borrow. How are we going to finance that? Is that going to be through a Parent Plus loan? If under these new limits, that will change. How does that work for, do I do a private student loan? Again, there's new strategies that need to be applied here because of the underwriting process that more and more families will be facing if this is a school that we're looking at. So here we can see that counterization of the shortfalls that we just saw graphically. So that's the same numbers here. And now we have to decide these other financing options. A Parent Plus loan is legally the parent's loan. Okay, so it is legally their loan. If they take a private student loan, it can be in the student's name, but to get the best rate or to even get approved, the parents will need to co-sign. So basically you're indirectly tied to that loan. It's going to show up on your credit report. And so things like that you need to be careful about when you co-sign for those loans. And now under these new rules, if say you now have 2 children or 3 children, and you co-sign for each of these amounts, when you go to finance the second child, your debt to income ratio is going to include that 107 that you borrowed for that first child. So now child 2, maybe child 1, you have great credit and you got interest rates at 7%. Okay. And now child 2 comes along and you have this new 107,000 of debt, and now you factor in interest. Your debt to income ratios are worse, and now you're going to be paying 8 or 9% or 10% for child 2. This is where the accumulation factor, because we're going to be dependent on more private student loans as we go through it, and they have a formal underwriting process. Here are the different options that parents can now look at. So Parent Plus loans are federal loans, so there's some benefits there. They have better repayment options. There's a death and disability option included on the federal loans. I typically use the federal loans first before we go to the private side, only because of those benefits. There's better repayment options than the private student loans, and just a few other different benefits. You could also look at the home equity loans. So that would be more of a line of credit, because if you take the money out as a loan and now you do the FAFSA, you'd have to report the cash, where home equity is not included in your FAFSA. So you would take a line of credit and not typically a home equity loan unless you wanted to lock in rates. And then your alternative loans, which would be a private student loan where the loans are in the student's name. And then then you as a parent would be co-signing that loan. Now, in some cases, you'd want to maybe avoid that in a sense, because there are a few non-co-signing loans for junior and senior year. Some companies have that on the private side. That will be important in that underwriting process. So those certain companies that do this, and this will be the trend that will be happening on the private student loan side, is they have to be in a certain school, a good program at certain schools. They're going to have a good GPA, a very good GPA. They're going to have only the only the federal student loan, so that 5,500 freshman year, 6,500 sophomore year can only be the loans they have. If they've already taken some private student loans in freshman year, then it's going to be more difficult, because that will now raise their number for their debt to income ratios on the back end. But then there's an opportunity there where some companies will do a non-co-sign loan for their junior and senior year if they have the right grades, the right major, and they know that their careers are going to be successful. So again, this is something else you need to factor in to your planning. So let's talk about the importance of the debt structure here. What's really important, a lot of people think, oh, I'm going to take the Parent Plus loans and my child's going to pay me back. Those interest rates are a little bit higher. You do have on the federal side, some better repayment options. Typically, the private loans have a 10 and 15 year period, where the federal student loans have depending on when you get them, up to a 30 year. The new rules will be 25 under the big beautiful bill. But again, that could be double. So if I take a private student loan and I borrow the same amount of money, the payback to get the best interest rate is going to be a 10-year term, where I can borrow the same money, and because it's going to roll over, I could have a 20-year. So that's going to make that payment over the 10 years double. So that's something else you need to look back at. What are the repayment options? That's what's critical there. On the federal side are the only loans that really qualify for loan forgiveness. Now, there is a new employee benefit that more and more companies will be adopting, where they can reimburse under the new rules there. So that will be beneficial. That was part of the big beautiful bill, which we will not cover here today. Students are limited. As you saw, they can only get really $27,000 over the first 4 years in their name. The rest of it would probably need to be co-signed. And now this is where the parents are limited in the future because of these new caps. As I explained at the very beginning, we talked about the cost of attendance limits versus the new firm limits, where you can only on an annual basis get $20,000. And you'll see an example coming up where we're going to have to go to the private side each year and at the end, depending on how you do this. And this is where your credit score has an impact on each new loan. They're usually annual loans. So when you take a loan, you take it out for the year, and depending on the school's structure, are they tri-semester, semester, or quarterly, those those loans, both on the private and federal side, are dispersed by semester, by the way the courses are, or the semesters are set up in the school. So here are the four different types of loans. So your direct federal loans, which would be the first, that $5,500, $6,500, $7,500, $7,500. The students, again, you have to complete the FAFSA form to get that. So that is in their name. The student has full responsibility. If they don't make the payments, it's going to affect their credit. And that's another reason why you'd want to take that, is it's going to help them establish their credit. There's no payments required. It will accrue, and depending on if you qualify for aid, we'll talk about that in a second. You may get some interest-free loans with the federal side if you have need. So again, this is why the FAFSA is so important to do. The private student loans, they're the student's responsibility, but the parents are indirectly related. So they are co-signing, or they're going to have to find a co-signer to get the better rates in that case. A Parent Plus loan is legally the parent, so it's going to show up on their credit report. The private loan will also show up on their credit report as a co-signer. So if you're in business or you depend on your credit, it'll be really important if you just co-sign that loan. As we said, home equity, that's going to be the parents only because it's your house, and this is a decision you'll have to make. And then the Grad Plus loans, they're eliminated for new students starting at 7/1 of 26. So this would be that graduating class. So if you have a college person that's graduating and looking to get their master's or things like that, the new limits go into effect, and depending what options they're going for their master's, either professional or not, or just a master's program, that would be the $20,500 or the $50,000, depending on the school. So Joel has asked, okay, can you clarify this chart again? Is this signifying the order of loans we should take first to last? No, again, each case is going to be different. Joel, I can't really say that would be the best. I would probably flip the private student loans. Again, each is going to be your own preference. You may be able to get a much better rate if you're going to be going out. I can see more and more people using home equity loans in the future just because of ease of access. It may be something you want to do, is get the line of credit now and just make sure you have it as a backup, and then look at the private loans and the plus loans. I would probably stay on the federal side. Again, it depends on how much you're going to have to borrow. And I think that's why it's so important to have the 4-year plan to see how much debt will you need per year is going to be really important, because do you have to go to the private side? We'll see that in a second on that 92,000 rule. Or can we, if we're going to have to go to this program, or this is the school that my child wants to go to, how do we finance that? Those numbers and what your resources are. That's where that cash flow analysis, you have to run through what your numbers are to say, okay, how much debt are we going to have to take on? As an example, you may have resources that you won't have to borrow that. And that's where maybe you take the federal Parent Plus loans just to avoid the underwriting process. So hopefully that works. If a parent has a high wage earner, can their kids still get the Stafford loans? Yes, you just have to complete the FAFSA form to get the Parent Plus loans and to get the direct Stafford loan. So your income is not now. We'll jump ahead a little bit. If you qualify for needs, you remember that slide we just saw, cost of attendance minus your student aid index number is what you qualify for need. There's 2 types of direct Stafford loans. There are subsidized and unsubsidized. Subsidized, to get that loan, and this usually comes up more when you are in the award letter section. One school where maybe you're a middle income family, as an example, and you're applying to schools at the private level, which are $80,000, and you're applying to the state school, and your student aid index number is $50,000. So when you apply to the Penn States, and again, I'm in Pennsylvania or whatever, or the different schools like that, our $50,000 student aid index number is higher than the cost of attendance. So we have no need there. So in those cases, you would get only the direct Stafford loan that's unsubsidized. If now we were looking at that $80,000 school and we have the 50, we qualify for $30,000. In that award package, we're going to get a we're going to get two direct Stafford loans. We're going to get a subsidized one, which means there's no interest being charged that loan while you're in school, and you'd get a portion of it would be unsubsidized, which would be charged interest. So typically freshman year, the limit for subsidized is $3,500, and unsubsidized is $2,000. So that's how that $5,500. So, and it gets prorated out as you go further along. And again, each year that's reviewed. You have to complete the FAFSA form every year to qualify for those loans. Hopefully that clarified your information. Okay, matter of fact, this is the next slide. Here's how those numbers work. So your direct Stafford loans, by completing the FAFSA form, it's a progressive amount, and that's those numbers I just explained to you. The subsidized loans, you have to have need to get those. So a lot of times when we get the award letters, parents will go, well, how come one school gave me the subsidized loan and one only gave me unsubsidized? Well, that's because one school you had need, one you didn't. Again, depending on what your financial situation is. If you're a high net individual, it's highly likely you're just going to get a unsubsidized loan, so interest is being charged that loan. But again, at today's prices, even high income families, you're looking at those, $100,000 schools, you could have a student aid index number in the 70 or 80s, and you would get a subsidized loan. So again, that's why we complete the FAFSA form. And another thing too, going back to the enrollment management section, by completing the number, that the FAFSA form, it tells the school you have the ability to pay. That may help you from a mission standpoint. If you don't do it, they kind of guess. But now by completing that, you're one, structuring the debt the best way, but you're telling the school, hey, this is on paper at least, I can afford to come to this school. And it may help with the admission side. That's another reason why we tell parents to do this. As I said, the Parent Plus loans are there. You need to have good credit. The direct Stafford loan is the only loans that will be available for graduate schools. So that's that $20,500 per year for the master's programs. And if it's a professional degree, that's where that $50,000 limit. But again, you have to complete the FAFSA form. And then starting next year, 7/1 of 26, the Grad PLUS loans are no longer available. There is a 2+ year runway left over. If you have a child that's considering grad school and they've graduated and they're on the fence, I would highly recommend, because the rule of the runway is you have to be an enrolled student and you have to have taken a PLUS loan for a portion of that year. So you have to have an existing PLUS loan that's on your under your FSA ID. Okay. And then your private student loans, as we just covered, they're your private student loans. There's formal underwriting process. We have a few companies we've gone through and recommend. Home equity, a good thing there. Then we start getting into other complicated financial planning things you need to look at. We don't do that work. We can give you need to do some work there. But, could you take a loan from your retirement plan? You have to know the rules of what that means. There are some state plans. Again, comparing them, the state plans are very similar to the PLUS loan programs. They are private loans. That'll be changing, but there's not the same benefit. So they follow the rules of the PLUS loans typically, but the repayment plans are not as generous. And then there's an income sharing agreement. They have kind of faded away, but it's not something we would typically recommend. And as I said here, someone asked before, is what's the structure? The student should take the direct Stafford loans at a minimum. That's why you do the FAFSA form. And then decide, do I look at federal? What the issue here, you have to understand the difference on your private loans versus your PLUS loans. If you don't take those loans, they don't accumulate. So what I mean by that is, if I don't take the freshman year direct Stafford loans, next sophomore year, I can't add the $5,500 onto the $6,500. It's a per annual loan that you can get. So you have to take them from the very beginning, or the way, again, if that's why another reason why you do the 4-year cash flow, you would take those freshman year, even though you maybe have the money to do that, and structure the debt so all the debt is on the student or less is in the parent's name at graduation. So again, these are the things you do that, where if you don't do that planning, it will become difficult. Right? Here's some other things that need to be factored in. The administrative fees on the federal loans, there's a fee, especially for the Parent Plus loans, it's 4%, but there are some rates there. The rates are semi-variable. So when we look at the federal loan process, Those rates are based, they start from July 1st each year. They change July 1st through 6th through June 30th each year. They're established in May. So using the May Treasury auction is what they use. So they're established there. I'm not sure if on the next slide I have this year's rates, but they were good for the year. And so when you look at your loans, and they'll be dispersed, say we're going to a semester school, so they'll be dispersed in September and in January, but they'll be split in half. So if I have to borrow, say, $30,000 in first semester in September, they're going to disperse $15,000. Second semester, they're going to disperse $15,000. So that's how that all works. Again, on the home equity, again, you'd have to take a home equity loan, would actually take the loan itself. Again, we would probably tell you to do a line of credit so you don't have an impact on your FAFSA. If you take a home equity loan and you have that money in the bank, even though it's a home equity loan, it's cash, it's an asset. So you don't want to do that. Again, depending on what your student aid index number is and your financial aid positioning looks like. Typically with the retirement plans, they're typically a fixed number that you're paying yourself back to that account. So again, that won't show up on your FAFSA either. But that may hurt your retirement. What happens there sometimes if you take a retirement account and say you get laid off or you want to change jobs and there's an outstanding loan on your retirement account and you can't pay it back within 60 days, that will come in as income and you'll have to pay the tax on that, and that will also affect your student aid index the following year. So again, knowing these costs and understanding the cost of money and the transparency of that, they're the things that we were now with these changes are working on to give parents a better idea of how to work through this. So someone's asking, so spread the 529 money over the full 4-year term. Again, Joel, one of the things there I'm going to say, I think you need to look at when we get to the private lending and things like that. Each school is going to be different on what you want to do and how you want to play that. And depending on what your other children want to do, there may be situations where each child you want to be fair to, but say in certain cases, you have the wherewithal to pay for some of it, taking on the Parent Plus loans early for the first one and saving those resources on the back so you have more time to pay it back. Again, each case is going to be different. With the multi-child borrowing that's going to be needed for each child, that makes it harder to decide which is the best way. And then what schools, each child's going to be different on what school they need or want to attend. And that's another factor you need to look at. That's what I was saying earlier. You have to not just have in the current model, the cost of attendance model, the limits, it was pretty easy. Each child was a silo. Because we now have dependencies on our debt to income ratios, we have to look at it more on a family side of when do we use our resources, because we may need to go to the private side and have underwriting. So again, these are some of the things we're learning that we need to now be thinking about. In the past, we didn't have to think about them because we could just use the plus loan programs because it was unlimited basically. So we didn't have to think about that, but that's a new change that we have to address. Okay. So for undergraduates, the new federal loans start on 7/1. Again, these are pretty significant. For parents and for students, this will affect the numbers here. The proper plan, as I said, needs to be done on the front end. Students need to run the risk of accessing financing to graduation. So having that plan kind of going, when do I use the 529 plans? When do I take which debt on is gotten more complicated depending on what schools. We compare, and now if we factor in grad school, what are they thinking about doing? How's the undergraduate? Because now we're going to have to do the same thing because of these limits on graduate school. So that has to be factored in. Do we save all this 529 money and take the Parent Plus loans and reduce that risk for grad school because we know they're going to go? There's ways to use your 529 money to pay down the debt also. So there's some things there that you need to do. As we saw, the limits on the traditional student have not changed. There's some talk that may change. But here's where the Parent Plus loan planning comes into play. You have a $20,000 limit per year with a cap of $65,000. So basically in your senior year, you only have, if you straight line that out, if you exceed that amount, the $20,000 per year, you only have $5,000 left over in that last year. You have to go get that from another place. Again, what I recommend, what I told you about those caps for the student. Now, it doesn't affect the Parent Plus loans, but the academic progress, it's called student academic progress, will impact that 5,500, 6,500 if they're not a full-blown student to that level. If they drop a course or they change majors, things like that can affect that number. Here's the example I'm referring to, keeping it very simple, no interest, no inflation, all these things here. So this family, this student needs $30,000 to go to their school. And we're going to say that for the next 4 years, they have a $30,000 funding shortfall each year. We've taken the direct Stafford loans. Okay, there's the 5,500, 6,500, 7,500, 7,500. There's the 27,000. If you remember back to the chart, we had the two donut graphs, showed you those numbers. And now we're going to use traditional thinking that we're going to need and take the Parent Plus loans at the very beginning. And we've taken the 20,000. We take the 20,000 second year, 20,000 the third year. Because we've already taken 60, now we're at 65,000. Okay, so we only have 5,000 left over. That 65,000 uses the original amount, even though there'll be interest charged to those loans. For approval, it goes off the original debt. And then we see a funding shortfall of how do we cover the 4,500 that's shortfall. Do we have that maybe out that we can use somewhere else? Again, that 30,000 number that we have at the very top already factored in our 12,000 and our savings. Okay. Again, we're trying to keep this pretty simple. So we don't have any money left over. This is our funding shortfall. And so now we have to borrow that amount each year going out, but we get to that senior year and now we need 22.5. Now, do we invert that order? And what I mean by that is, do we flip it and take the debt on in their freshman year under the private student loans, and then use the federal loans on the back end because our debt to income ratios will be better? We don't have that debt. We get to our senior year, we already have 65,000, and we already have a portion of the 33 already in our numbers. Our debt to income ratios are worse than they would have been at the first year. So these are the things we have to think about. Maybe we think we're going to have the 22,000 at the end. We're going to be saving more money. Maybe there's an inheritance. Maybe a grandparent's going to step in. But these are the things that now we have to consider as we go through this. And this is the plan of why it's so important to have a plan, a 4-year plan at a minimum, and factor this in and seeing how we structure that, what our shortfalls are going to be, and how do we pay for that. And then having the transparency. What's not on this chart is what are going to be my repayment options once I get out. So say maybe this is your youngest child and you're going to be 60 years old when you're done. And now you have, a 20 or 30 year payment that now you're going to carry into retirement. So again, these are the things you need to be thinking about going forward with these new limits. Now, this is something as a strategy we're now putting in place, and it should be part of your planning for this year. You should have at least one school that we believe that when you borrow 92,000, how does the 92 come about? Well, the 92,000 is the 27 the child gets by completing the FAFSA form, right? And the 65,000 that the parents can get on the Parent Plus loans. Then there's no underwriting risk at all. We don't have to do that. Now, again, if you can stay under the 92, they pick a school. Again, we'll probably see new ways to do this. The way we typically talk is the student's going to be a full resident. Could students start going to community college or go, like here I'm again in Pennsylvania? We have a local campus of Penn State that's 15 minutes from my house. Do they go there for the first 2 years and we save the room and board for those 2 years and then go to the main campus? There's going to be new iterations of how people get to college or use their funds to minimize either underwriting or minimize total debt going forward. So these are some things here, and we call this the 92,000 rule, is if we can stay having that 4-year plan and staying under the 92,000 is one of the strategies that we can do, because then we move into grad school and say you can stay under that, and maybe you save 529 money that you borrowed up that could be another solution here. But what's really kind of scary to me is that the current list of schools that you've probably gotten are still using the cost of attendance limits. Most of the guidance counselors and the colleges are not talking about these new limits and the impact it's going to have, because now you commit to the school and you won't know this shortfall. Now, you knowing today by attending today's meeting is that's in front of you. But what will happen is, what parents could see is that they commit to the school, and now they need $50,000 for that freshman year, and now they only get 20, and now they have to get private underwriting for the 30 to get into that school or to attend that school that first year. But can they keep on doing that to the 4 years? So that's the other issue that we need to be considering. So this is a perfect example of the schools that would work. Again, the way we look at it, again, what you're seeing is some of the details, but here's the 4-year cost. They didn't qualify for much. This was a state school. And you can see here, there's the 27 and our funding shortfall. Now, granted, the 92, is it 92 hard? No. If I'm at 95 or I'm at maybe 100,000, could we figure out that other $7,000 or $8,000? Yes, probably. But it's a range that you need to at least understand, and we make it a hard number at 92. But again, if that's the school that your child needs to go to or wants to go to, or that's the best value you can find, then you can make it work without going under the private underwriting process. So again, this is the new way we need to be thinking about it. So that was a lot of stuff to absorb. Again, we're coming up on the end here. Forgiveness has not changed. Again, we're going to cover that in much more detail in the next meeting. But forgiveness, it is getting easier. So that will be a good thing. Right now, we're going from 9 methods to 2 for new borrowers. So you only have access to 2 methods. Private loans, there's not really, some states offer some things, some employers. This typically offered in like rural areas where they're looking to recruit people, where they'll also include private loans. That new benefit student loan assistance, there could be ways that companies can pay down your student loans. But there really wasn't much change in that. Probably the biggest change that happened, it used to be a strategy we used for parents, that they could qualify for PLUS loans and then use what's called an income-driven repayment method. Again, we'll cover this next week. But to qualify for public service loan forgiveness or any of the loan forgiveness, you have to use what's called an income-driven repayment method or an IDR method. The new RAP program is the new IDR method. You need to use those to qualify for forgiveness. Parent PLUS loans do not have access to the IDR methods. After loans of 7/1 of 26. So this freshman class, when you take a Parent PLUS loans, the only loan repayment option you have is the new standard. So this just gives you the repayment options that you have under the current method. We have there's 4 different fixed methods, and then there's 5 different income-driven repayment methods. Not going to cover that in great detail because this freshman class does not have access to those. Now, if you have current debt, if you're a parent that has current debt, you need to revisit this for your students you've taken on debt. So maybe you as the parent 1 has taken on the debt and it's maybe pretty high and you want to have access to an income-driven repayment method, you'll need to do a consolidation in sometime in January, February, March, depending when that last loan comes out. And all future borrowing will have to go to your other spouse because you only can be in one repayment method. So here's where we're headed. If you are in the fixed methods, you'll be able to stay in them in the legacy and continue on. But if you have debt after 7/1 of 26, the only method that's available for Parent PLUS loans is the new standard. You do not have access to the RAP program, the other IDR methods. If you have your own loans, in some cases for your children, that they have federal loans, they have to make the right decision, get in repayment to have legacy into the access, or they'll only have access to RAP. So again, this is where some additional planning for current students is important. Just give you a quick view of what the new rates are for the new standard method. So they're not as kind as they currently are. So and the numbers are lower. Right now, if you do a consolidation, this is where, again, a consolidation would be important for a Parent PLUS loan borrower. If you have over 60,000, you can get 30 years. Under the new RAP program, you'd only get 20, and you'd have to have over 100 to get to 25. So again, that's how that works. On the RAP program, again, this is where the child would have access, or in their repayments, graduate students, If you take a loan after 7/1 of 26, these are the only two options that you have. These are the two choices. There's some benefits to the RAP program that are good. So it doesn't have negative amortization. There is actually contributing if you're not making the payments, covering the interest. They'll actually contribute to your principal reduction and things like that. So again, this gives you a sense. And this is all important that you understand your tax filing status, because it's now all flowing through. The FAFSA does too. The repayment methods will also pass through the IRS system, and it's more dependent on the integration with the IRS system. Just want to give you a quick sense of where your source of information is. So loan servicers, they cannot give you any personal advice. So everyone thinks it's free advice, but they can't talk about income-driven repayment methods, some of the things that we've talked about today. Should I file my taxes married and joint, married and separate? That has stayed through the big, beautiful bill. That was debated that it wasn't going to, but that's an important part. As more and more people, 62% of student debt dollars are repaid using income-driven repayment methods. So your tax filing status is really important of how you file your taxes. So an example would be, if you file your taxes, which is typically cost efficient, tax efficient, and say you're making 150 joint, and now one's making 50, one's making 100, and the one that has the debt has 50, it's going to use the 150 to calculate their income-driven repayment method, where if they file married separate, the one that had the debt, which was the 50,000, would be based off the 50,000. So again, these are the things that you need to look at. Your financial professionals, many of them understand the broader picture, so take that. But again, this has gotten very complex. They are somewhat limited on the student loan forgiveness process. So that's something you need to do. And on the private lenders, again, you would have the private lenders. They're looking for just good payers and looking for people that can refinance. So again, the advice there is not always the best. We've had a few cases where someone did a consolidation and they qualified for loan forgiveness, and because they left the program. Once you go to the private side and leave the federal program, if you take federal loans and move them to the private side, you cannot come back. One of the other issues that you have is the loan servicers and the limits. As I said, more and more people are using income-driven repayment methods. So in the loan servicers, they can't talk about, how do I maximize that? How do I minimize my adjusted gross income? Which way should I file my taxes? They can't give you that advice. So that's, again, free advice is what it's worth. On the tax side and financial advisor side, they don't know the repayment advice, don't know the forgiveness rules as well. And what happens, especially with the tax advisors, their goal is to lower your taxes. And typically, if you file married and separate, your tax exposure is going to be higher. What they have to do is take the next step and show you what that difference is. Because example would be, maybe you're going to pay an extra $1,000 in taxes if you file married and separate, yet you're going to save $500 a month on your repayment. That example I gave you, they would use the 150,000 versus the 50,000. Say that was $500 a month in your payments. You'd save $6,000. That $1,000, the net benefit was $5,000 in your pocket. And that would be something that would be beneficial. So again, this is where some of the limitations, just want to make sure you're aware of that. And if you have any questions, we're coming up here on the end, please type them in. So in this whole process, we're wrapping up here, 2 more slides. Understanding the outcome, the best way to save money is graduate on time. Use summer courses, use your community colleges. If your child falls behind, my children all did. Try to make and understand both the education and cost to the career they're considering. My new, a lot of times I talk about this when I do presentations, is what's your child look like at 25? How much education they're going to need, and who's going to be paying for that? How can they do that? And that will be changing. I think we're going to see more of a need for students to get jobs, and maybe employers pay for a portion of their master's degree or go to school at the same time. Again, some of those jobs have now required postgraduate degrees before you can start. As an example, my oldest is a speech pathologist. You need to have your master's to even get that job. So that'll be a very, very interesting to see if that changes. The evolution of the responsibility. So again, the child's taking on debt, having those conversations, that you're making those decisions for that 18-year-old. So that's really important that they understand that the debt's in whose name and who's going to be responsible to pay that back. Again, it affects both the parents and the students' financial futures. This is where the new outcomes is important to understand the cash flows. That has to be done. It's not done right now. And the schools only give you 1 year of information because of those SAP rules. you need to have a plan and get independent advice to get that, to make sure you're making the right decisions. And again, with these new rules and these limits, you have to plan for the whole family. It just can't be per child, because unless you have the money to pay for each child, no matter where they go. But as a parent, at today's cost, that's pretty difficult to do. So just to summarize this, again, these are major changes due to the Big Beautiful Bill, both on the loan repayment and loan structure side. We're going to see an increased use of private student loans, and you're this graduating class of both college and high school students face these new rules as we cross into the as I said, it changes on 7/1 of each year. So you can enroll. It's not like you can front load or get in and get under these new rules beforehand. So that's going to be really, really important. What's also very different that we kind of hinted around, the elimination of the Grad PLUS loans will put more pressure for parents to be involved with graduate school. They're going to have to be involved. So again, this is where that accumulation, they didn't cover that today. I just thought it was going to be too much, but the accumulation of the debt will now impact other children. We talked a little bit about it, where we've borrowed for child one, and maybe we have great credit and all that, but our debt to income ratios are getting worse over time. And now we're going to get higher rates. Now, granted, some of that can be driven by the marketplace. So if interest rates rise, it may be that, but if interest rates fall, we still may be paying a higher rate because of our debt to income ratios and that underwriting process. I think a big problem here also for us, a strategy we used all the time, again, who should take on the debt? We used to be able to use people who qualify for public loan forgiveness, parents, and eliminate that. We had saved people hundreds of thousands of dollars that way. That process or strategy is no longer available. And as I mentioned just a second ago, the accumulation risk is becoming a bigger factor. People have to have a plan basically for their family. So there's our information. If you haven't signed up for our newsletter, I'd highly recommend it. Please pass the word. If you have questions, send us an email or give us a call. And just looking the last one or two questions here. So Joel's asking for current sophomores who need to happen in the next 6 to 12, whose need 6 to 9 months are due dates. Oh, so let me explain how the 3-year runway works. This is really important. Don't have a slide here. I was trying to keep it simple. And I really thought that most of the people were going to be for new students. But the 3-year runway, how that works, if it's a junior, it doesn't matter. And there's a class that is at risk. So if you remember, I said the way the 3-year runway works is that falls under the cost of attendance limit. So it's cost of attendance minus your financial aid is what you can borrow under the Parent Plus loans, under the Grad Plus loans, if you have them in place. So you have to have an enrolled student, and you have to have a Parent Plus loan that's taken out. So if you haven't taken a Parent Plus loan out for that child to date, their second semester, their spring semester that you're going to pay for, they'll be enrolled whatever grade it is. They're going to have you as a parent will have to have a Parent Plus loan. If they are a graduate student, they will need to have a Grad Plus loan to get the remaining part of the 3-year runway. All right. So that's important. So enrolled student, active student, and an existing plus loan, either grad or parent, by 7/1 of 26. So the only way to do that officially really is to take that loan in December or January or February. Sorry, January. So that you have, the enrolled student and the loans in place. That will allow you to go out to 7/1 of 28 through, maybe your child doesn't graduate on time, they change majors, but after 7/1 of 28. So let me explain the issue that's not being explained to parents. If you have a current freshman student, okay, 7/1 of 28, the cost of attendance limit expires in total. So let's take an example there. I have a freshman, and now I've borrowed the $30,000 Okay, the example we had, freshman year, sophomore year, junior year, $30,000. I've taken that number. On 7/1 of 28, that senior year, say are going to graduate on time, they have $90,000 of accumulated Parent Plus loans for that child. They will be over the $65,000 limit. They will then not qualify for the Parent Plus loans, the remaining balance. So it's the way it's written, and there's some inconsistencies or misunderstandings. The way it was written, it was 3 years or time of graduation. But a lot of people didn't read the second part of that, whichever comes first. So the maximum, so when people went in freshman year, they only have 3 years of those Parent Plus loans, of those cost of attendance. Now, if they don't borrow up to the $65,000, say they only borrow 40 over those first 3 years, they would still have 25 left. But if they've exceeded that number over the $65,000, they will have to go to the private side to finance that senior year. And so that's going to be the problem. So again, you have to be enrolled, have an enrolled student, and have an active either Grad Plus or Parent Plus loan associated with that child, associated with that student. Okay. All right, Joel, hopefully that answered your questions. And I think we're way over again. So this is twice in a row that we've gone over time. Hopefully you enjoyed this and it's been helpful for you. And please pass the word, spread the word. I'm really worried that, again, there's not been much said about these new loan limits that really affect what decisions you make for your children as far as financing and education. And my biggest fear, two things that are really worrying me, is that people will attend schools not having the 4-year plan. It's a big change, and get to their sophomore, junior year, and it's the right school for the child. And either it gets too expensive to borrow the money, or they can't even get approved for the amount that they've borrowed. And this is where maybe you've borrowed $200,000-$300,000 for an older child, and this is your youngest, and now you already have that debt, and now it's going to be hard for you to get approved for the private student loans. Again, this is a fear that I have. And then the freshmen, as these current freshman class, they get to senior year, it's been a great school, and then they may not be able to graduate because they can't get the finance for that senior year. So these are the worries that I talk about, and just pass the word. And if people need help, we have private services that help you do this, and we can help you navigate this process. Thanks so much, guys. Have a great day, and we'll talk to you next month with the student loan forgiveness programs. Have a great day.